So I'm going to go ahead and start our program. Welcome to you as a speaker and participant and the panelists, but also welcome to our attendees from around the world. The program is known as Digital Assets Market, or the short name we're giving it is Digital Assets. And what Patrick is going to be doing in a moment is giving us an overview through a slideshow, PowerPoint, and we'll go through some Q&A between myself as the interviewer, moderator, but basically to try to draw out Pat with information to help us better understand the digital assets. Words like cryptocurrency, crypto, specific types of cryptocurrency like Bitcoin will be the topics today. A lot of those words have come across our reading or our discussion, but a lot of them are fairly poorly understood. And today we hope to get a lot further with that understanding. So first I want to introduce our main speaker, Patrick McCarty. Patrick is of counsel with the law firm of Ruddy Gregory in Washington, D.C. He's a professor, an adjunct professor of law at a number of universities, including Georgetown University and Catholic University. But he has been teaching a class at Georgetown University Law Center on cryptocurrency since 2018. And if you think about the subject matter, that's a fairly long history of involvement. Patrick brings to this topic and to today's program a long history in United States government roles involving the regulation and financial markets. He was involved in the Dodd-Frank Act, the drafting of such. He was very involved in the United States Senate and the U.S. Congress as a staffer. I was a professional staffer in the Agriculture Committee. He's worked with the SEC, the Securities and Exchange Commission chairman. He's been involved with the Commodity Futures Trading Commission and has been active in both the private and public sectors. He got his degree from Catholic University School of Law and college at the University of Virginia. So he's a wahoo. So in any event, with that background, I'll just introduce myself and the organization. I'm Michael Brown. I'm a partner at the law firm of Brown, G. and Winger in the San Francisco Bay Area. And our firm, like Ruddy Gregory, are members of the organization called the Alliance of Business Lawyers, or short, the ABL. And we bring together 5 continents of lawyers and law firms who work together in an alliance, which basically means we have branch offices around the world. And it's great to have you, Pat, and great to have Ruddy Gregory as part of the network. And thank you so much for giving up your time today and preparing to give some comments on digital assets. With that, let's jump in. Before you have a PowerPoint, why don't you go ahead and introduce how we want to go forward today.
Well, thank you, Michael, for that nice introduction. And I'm very excited to be with you today. And yes, I've been investing my time, but not my money, in digital assets for the last 3 years. And it has grown dramatically. And we're going to go through that today with my PowerPoint, which I'm going to share with you here just in a moment. We're going to try to move through this fairly quickly. I'm encouraging people to basically submit questions via the chat. We will get to those questions. If not today, we'll get to them after the program, but you will get a response to your question. And either that or Mike will direct me to that question during the course of the seminar. So let's get in here. I'm going to share my screen and we're going to start through my PowerPoint. Okay, I think that's there. Can you see that, Mike?
Yes, we can.
Okay, so here we go. Well, what's the agenda for today? Well, the agenda is breaking it down into digital asset basics. What are they? What's some recent news that we've seen? And then give you some ideas to the number, size, and market cap and most actively traded digital assets. Then we're going to move on to the U.S. legal and regulatory treatment, followed by stablecoins and CBDC. Not the same, a big difference in that, and it's going to be very important going forward. we'll look at tax treatment, which has been a really big issue here in the United States. In terms of, we're going to look at custody of crypto. We're then going to look at some of the things, what the outlook for digital assets are in the new administration. So, what are digital assets? What are the basics? Well, digital assets are electronic code. They're not tangible assets. These things are not tokenized physical assets like gold, oil, and stock certificates. That would be a digitized asset. We're looking at really things that are created, and ownership and transactions are recorded on the distributed ledger technology, which people call the blockchain. So ownership is usually recorded on I guess I would call it a system that is can be permissioned or non-permissioned, but the point would be is that it's the way to keep track of who owns what in this space. There are thousands of digital assets. I'm not sure that people are mostly aware of this. It's more than Bitcoin and Ether. There are 8,800 tokens, separate tokens today. And that's more tokens than there are NYSE and NASDAQ listed stocks. So it's incredible. It's hard to keep track of, and new ones are being added every day.
So Patrick,
in addition to the digital assets.
So Patrick, just to address that last point, you said there are 8,800 tokens. Are you basically, is that the equivalent of there being 8,800 stock companies that are listed on a stock exchange, basically 8,800 places to go with either using that token or investing in that security? Just help us understand what it means to have 8,800 tokens or digital assets, because that seems overwhelming to me. So go ahead, and can you explain that to us a bit?
Well, yeah, we'll get into dividing those up here in a bit as we move along. But the thing is that you have to distinguish the digital assets themselves from the blockchains on which they are actually recorded. There's not just one blockchain where all of those 8,800 are recorded. In fact, Bitcoin has its own blockchain. Ether has its own blockchain, as do several others. And in fact, actually, Ether's different. The Ethereum blockchain is basically built as a blockchain that other coins can be listed on. So it's a very different kind of thing.
Yeah, I'll let you go ahead. Continue with your where you're headed.
Yeah, and I think that's a really big deal. Now, the thing is that, what are digital assets really being used in everyday businesses today? They remain almost primarily investments. Things are starting to change, but I don't think there's a lot of people wandering around. I mean, we've seen recent discussions about Tesla accepting Bitcoin to buy cars. I don't think that's happening a whole lot. And I think that Ether is not being used to buy that as well. But the thing is that it's starting to get into the mainstream when you see people Square and PayPal saying that they will accept it. And I think it's the coming thing, but it's not here yet. Some recent news in this area is really kind of interesting. You saw that Elon Musk said that Tesla invested 1.5 billion of their treasury cash in Bitcoin in January. And MicroStrategy has issued a bond for $650 million to buy Bitcoin. Coinbase, which is the largest, I guess, exchange or digital asset trading platform in the United States, has filed for an IPO with the SEC, and the market cap could be $100 billion. And that's important because that market cap would be larger than any of the existing equity or futures exchanges that exist today. It's larger than the New York Stock Exchange, larger than NASDAQ, larger than CME, and larger than ICE in terms of what the price would be. So I think that that's just an indicator of where things are going. One big deal was basically this last week, the Bitcoin price hit $60,000 a Bitcoin. That's quite phenomenal based on the fact that last March, Bitcoin was trading at just above $5,000. So pretty incredible when you think about it. So remember, the digital asset market is more than just Bitcoin and Ether. 8,800 separate tokens, as I said. The market cap has exploded. It's now up to $1.75 trillion. And just for reference shape, in June of 2020, the market cap was 275 billion. So it's gone up 1.5 trillion in market cap in less than 12 months. So this is taking off. One thing about this, though, is that the digital asset market has a huge concentration of value in the top 10 coins by market cap. Almost 85% of the total market cap are there. All these tokens are above 10 billion in terms of market cap, and I'll show you some details on that. And most of these top 10 are the ones who are actually most actively traded, but not all. So we'll go through and take a look, see at some of that, just so you get a flavor for some of the names and what the market caps are and what they look like. So Bitcoin and Ether dominate the market capitalization. As you can see there, about 73% of the market cap, 1.75, is just Bitcoin and Ether by themselves. The remaining 8 of the top 10 represent another almost 12% of market cap. But you see how you drop from Bitcoin with a $1 trillion market cap and Ether with 200 down to 45 billion for Binance Coin and Tether and all these other ones. So it drops off very quickly. One thing I would say is that you have to keep in mind that this is a market where there's a lot of tokens that are starting to basically they go in the same direction as Bitcoin and Ether. If Bitcoin and Ether are going up in value, you're going to see them pull along a lot of the other digital assets. If Bitcoin and Ether go down, same thing happens in reverse. But the point would be is that the vast majority of these tokens, 8,790, only represent 14% of the market cap, 216 billion. That's not a small number, but it's spread amongst an awful lot of tokens, and therefore you're talking about a lot of penny stocks, actually. So that puts it back in the equity, view. Trading volume. This is, and I'll note up front, we're talking about Tether, Bitcoin, and Ether dominate trading. And normal 24-hour trading volume is about 137 billion. And you see right there that Tether dominates. It's much larger than Bitcoin. And Bitcoin is much larger than Ether. And after that, it drops off. Now, some of you are going to say, well, those numbers don't add up. And the answer is because you've got a lot of people who will trade, they will buy and sell Bitcoin, and then when they sell it, they'll actually exchange it for Tether. And so the numbers here are not going to add up to 137 billion. It's going to be significantly greater, but that's because people are trading, they might trade Ether for Bitcoin or Bitcoin for Tether or Tether for Ether. So there's a lot of combinations there. But as you can see, the big three are absolutely dominate the amount of volume that's being done. So think about that. Investors think about liquidity in and out of something, and that's one thing that you need to look at.
Before we get into the regulatory framework, and I think this is a good time to kind of think about a little bit of a dichotomy or different directions that this conversation can go. One is this whole side of investment, which I think you've covered well in the sense that what the volume of activity is and where it seems to be happening and what seems to be the patterns of how it behaves. And then we have the issue of it being a currency or being used as some have described it in the beginning as a stable, if you will, could it be, but a stable currency in the sense that it's like, some have likened it to gold, in the sense that there's something that that really exists, a physical metal that exists. And that obviously gets very confusing because of the behavior, and you look at the change in value. It's very unlike anything I think we've ever known, unless you have an analogy for us. But how would you kind of encapsulate the notion of whether this is an investment or whether this is a currency in terms of our better understanding of what it is today?
I think the most people would agree that most of the digital assets are being utilized as investments, and they're not being utilized as currencies. The only exception, I think, on that would be with respect to stable coins, and US dollar tether in particular being one of those. There's a small subset, and we'll talk about it later in the presentation, of these about 100 to 150 stablecoin projects that exist in the world. And that's out of the 8,800 digital asset tokens that we have. And those can be based on commodities. They can be like oil and gold or silver, or they can be based on things like an index of digital assets, or, and this is the most popular of the three, they can be backed by a fiat currency. And there are multiple US dollar pegged digital assets, stable coins, that are meant to basically maintain a stable value of $1. There are also ones which actually do that for euros, for sterling, and for yen. And it's interesting because US dollar tether that we just were talking about is clearly the largest and most popular of the stable coins. And that is a real currency because it keeps a stable value. And people know that, in fact, there's not going to be a huge discount in terms of purchasing it. The swings that you see in Bitcoin and Ether and the value of those is something that stops it from being a real currency. People want to have something like, they're used to what the unit of account is in terms of dollars and euros and sterling. And that's the reason why the volatility in the price of Bitcoin and Ether is something that drove the creation of stable coins. The questions have started to be raised, though, by not only central banks, but also treasury departments around the world about, so should we let people private entities create a coin that's not regulated, that is basically backed by one of our fiat currencies without any type of approval or any types of regulations? And that's
I'm bringing you back to your agenda and your topics. You're about to talk about the regulatory approach, and since you're a United States trained and a lawyer teaching at United States law schools, we recognize that your focus will be on American institutions and American law. But we all know around the world that countries influence each other in terms of how to approach these issues. But why don't you start us down the path of understanding kind of the regulatory, maybe more of an issue spotting as opposed to a framework, since it is just emerging?
Well, it's interesting you say that, because I think all jurisdictions are trying to basically address this issue. And you've seen certain things occur in Europe. They have proposed legislation, which is kind of broad, hasn't really got a lot of details around it yet, which should be in place in about another year and a half or so. You have the UK, which is doing their own thing since they're no longer part of the EU. Singapore and other Asian jurisdictions have actually been, leading in terms of doing stuff. I know that Bermuda actually has a very progressive statutory provisions that deal with digital assets and crypto. So it's kind of a mixed bag. I think, the regulators have all woken up to digital assets and realizing it's no longer just a niche product that only a couple of people trade. it's a big deal now. And I think the thing is they're searching for what the right regulatory response is. And I think one of the things to keep in mind here is that with not there's no uniformity on the digital asset side. Some of these things are securities, some of these things are commodities, and you have different aspects and different provisions related to all of them. You can't just basically say, well, they're all securities, and you shouldn't say they're all commodities. And I think the thing is some of them can function as currencies, but it's a question of basically, well, if you're transferring value, which FinCEN and the AML people are worried about, they're not so much worried about stable value. They're worried about basically people moving money or value without being, for nefarious purposes, whether it's money laundering, whether it's avoiding taxes, whether it's, doing, darknet transactions. It depends upon who you're talking to at a particular time about exactly how they would view some of these. But let's go through that from the US side, because I think each and every other jurisdiction is starting to feel their way through this area, and it's going to be a while before they actually decide exactly what, how do we bring us together on all this. It's not going to happen easily or quickly. So the point here is that, are they securities, are they commodities, or are they currencies? And I say it's a qualified yes to all three. Some digital assets of the 8,800 could be classified as being one of those three. And I think it's important to remember kind of, each regulator looks at this through their own lens. In the United States, in March of 2013, we had the Financial Crimes Enforcement Network, FinCEN, issue the first guidance in the United States saying that virtual currencies digital assets are virtual currencies, but they're not the same as real currencies. They're not legal tender in any country. Therefore, we're going to treat them in a little different way than real fiat currencies. They subjected these virtual currency transactions to the Bank Secrecy Act and anti-money laundering laws, which we're all familiar with through FATF and other international fora. Most digital asset trading platforms in the United States and some of the ones outside of the United States that permit US customers to transact are registered with FinCEN and some of the United States where they do business as money services businesses. And those MSBs focus on money laundering. They are not real exchanges, even though they permit people to buy and sell digital assets and exchange them for fiat currencies. They're not operating like the New York Stock Exchange or the Chicago Mercantile Exchange. They are very different and limited purpose. Now, the US CFTC started back in 2015 with some enforcement settlements where they said Bitcoin and Ether and FX are commodities under the Commodity Exchange Act. And they've permitted, that is the CFTC, several exchanges to list and trade Bitcoin and Ether futures and options. And that started in December of 2017. They've also permitted swap execution facilities to offer Bitcoin swaps, options, and non-deliverable forwards since 2015 as well. So the CFTC has kind of moved ahead in this area relative to the US SEC. I would say that two interesting developments in the last couple of months has been that the CFTC and DOJ sued one of the largest digital asset trading platforms outside the United States, BitMEX, for failure to register as a designated contract market with the CFTC. That was because they were permitting US customers to transact on their facility, and therefore, since they were doing derivatives, futures and swaps, they should have been registered. That's a landmark case. And you've also seen some civil suits related to pump and dump and fraud schemes.
So are those lawsuits being pursued in the United States federal and state courts?
Both of those cases are actually federal courts
Okay.
in the United States. So the SEC, which most people are concerned about when you start talking about this, has a history in this area, which is kind of interesting. They issued a report called the Dow Token Report in July of 2017, where they, for the first time, said that some digital assets qualified as being investment contracts and therefore would be treated as securities under US law. Quite interestingly, the SEC has said multiple times that Bitcoin and Ether, the two largest digital assets by market cap and amongst the largest in terms of trading volume, are not securities. There is a lawsuit that the SEC is pursuing right now against Ripple related to the coin XRP as being an unregistered securities offering. And that's a very, very big issue. XRP is one of the largest coins in the top 10 by market cap, and it would be the largest, I guess, digital asset security by market cap if the SEC is successful in their litigation. Now, the SEC has done a lot in this area. They got very aggressive after issuing the Dow Token Report. They've got over 20 settlements and numerous court cases related to a variety of registrations that were not, people did not get, that annoyed former chairman, SEC chairman Jay Clayton. He was quite vociferous about the fact that the gatekeepers, lawyers, accountants, and others had failed to advise their digital asset clients that they were violating the securities laws. One notable enforcement action, the SEC fined Block One $24 million for an unregistered securities offering. I would note there that that was actually, some people have criticized that fine because Block One raised over $4 billion. So 24 million was not a whole lot of money to Block One to settle their I guess proceeding, even though it's a big number, and I'm not sure, maybe that's not a lot of money to you, Mike. That's a lot of money to me. Now I would say that the interesting, I mean, a lot of the sort of focus has been on Bitcoin and Ether ETFs, and the SEC has not permitted that so far. In fact, actually, they've issued several orders which disapprove proposed exchange rules that would permit the listing of a Bitcoin ETF on their exchange. And the primary reason is basically the SEC is saying that the Bitcoin and Ether cash markets are not regulated like real markets. And they think that those ETFs could be manipulated because the cash market is not regulated as it should be. We'll see whether that actually, there's a huge, I guess, outpouring of expectation that Gary Gensler, as the new SEC chairman, will actually permit a Bitcoin ETF to be listed and traded. I don't know if that's going to happen.
So let me ask you this: is there a conflict? Obviously, there's a lot of ideas floating about in this last few minutes of your comments. Is there a conflict between those who seek to regulate down the path of securities and making sure that they are registered and that people who are investing or buying them know what they're buying, versus the side that wants to regulate to make sure that these tokens aren't being used for nefarious purposes, money laundering or criminal activity?
No, I mean, I don't think there's any inconsistency there. I think they just they have two different reasons, areas that they're focused on. I mean, the investor protection point of view that the SEC has related to, if it's a security, then you have to follow the securities laws, and there's disclosures and registrations that have to be secured. The AML part of this is basically, we just don't want the financial system and products in the financial system to be used for tax avoidance, organized crime, other things like, purchasing drugs, there's an awful lot of dark net activity that you see with certain digital assets that makes it kind of a problem. And this is something which the regulators have been going after, and the law enforcement people in particular, for decades. The Bank Secrecy Act has been with us since 1970. And it's been about trying to basically stamp out not only tax evasion, but also organized crime and moving money. So that's kind of the idea.
I know that you're going to talk about go in a little more depth in the investor protection issues.
Yes, we're going to move on to that. And I guess the thing is that retail versus institutional investment, it's really important to understand this. I guess I was shocked to read that 36 million Americans own crypto. That's over 10% of the population in the United States owns some crypto. And that means that, in fact, and a lot of it is retail investment. It's an area which I think, and I've seen this before, is that once a particular area or asset gets on the regulator's radar screen, and I think the same thing would be said for like hedge funds back in the early 90s, and then swaps after the credit crisis in 2008. Regulators and legislators feel like they need to do something. And if 36 million Americans, and a lot of them are retail investors, then I think you need to start thinking about, we need to protect investors from fraud. And so that's 36 million is a big number. Coinbase, which we talked about earlier in terms of filing for an IPO with the SEC, has 40 million accounts, which one would think is, there's not that many doubles, but that's an awful lot that's millions of accounts. It's 4 times bigger than what Schwab has in terms of the number of securities accounts under their broker dealer, and Schwab is the largest broker dealer in the United States. So that gives you some sizing there. It's like if it's 4 times the size of Schwab, it's really a big issue, and it should become part of sort of the regular financial world. It's time for it it's no longer just a niche market. And we see institutional investment starting. We talked about Tesla and MicroStrategies earlier. There's roughly 400 hedge funds that are focused on Bitcoin and other digital assets. I saw something the other day that said inflows into hedge funds that actually invest in digital assets was up at $4 billion for the month of February. So there's a lot of money starting to flow into this. CME, Bitcoin futures and options, started in December of 2017. So there is some, instead of the SEC side of it, there is actually CFTC regulating the Bitcoin and Ether part of it. Toronto Stock Exchange just a listing and trading of a Bitcoin ETF. And that's in sharp contrast with where the SEC has been. An interesting development has been that Grayscale, which is an asset manager, and it has a Bitcoin trust and an Ether trust. And they registered their securities with the SEC under the 1934 Act because they had adequate amount of net assets under management, plus the number of investors. And it's not an IPO, but it was to basically say, well, okay, so we're registered with the SEC. This is something which people can buy, and they're following the securities laws, which I think is a good thing. And contrast that with the fact that the UK FCA banned retail trading of crypto derivatives, and that just started in January, if I remember correctly. I think the UK FCA said, we think that these things, there's bubbles, and retail investors may not be able to handle futures, swaps, and options on these things. So we're not going to permit them to invest in those things, or at least to be listed on exchanges or offered by broker dealers who are located in the UK.
I have a question for you, because we're talking about investor protection. And in the beginning, it seems like you're covering more of the protection between those who put these tokens out there, and those who are investing effectively are using them, versus the sort of protection that we think of where with fraud, where a different sort of fraud, where someone is manipulating manipulating the same thing in terms of a transactional approach. In other words, someone may be offering a token where they really don't own it. I'm thinking about the kinds of things that are, your everyday fraud, which probably dates back several millennia, where there's some form of it, throughout human history. So we're now obviously just in a different marketplace. There's a different thing, but how much attention is being given around the world, specifically in the United States, in your experience, to address the manipulation or the you mentioned hacking, but those sorts of things?
Yeah, let's put it this way. On the screen that I've got here on hacks, fraud, and darknet, I think since this grew up, starting in 2008 when Bitcoin white paper was released, and actually the Genesis block was mined in January of 2009, we've gone from 0 or 1 digital asset up to 8,800. And I think regulators around the world, probably you could say they ignored it to start with because it was minor. And maybe some people thought it was a fad and that it would just work its way out. I think that, as you can see here, there have been all these hacks on these exchanges, which some are registered as real exchanges while most are not around the world. And I think it's because the regulators have tried to sort of decide, well, exactly what is this? As we talked about earlier, is it a commodity, a security, or currency? And then what's the right, do we want to, you keep hearing the thing is that advocates for digital assets say, if you impose too much regulation on this, you're actually harming innovation. And so I think a lot of regulators and people around the world have tried to basically take it slow in this area because there haven't been that many people invested in it, and the market has not been that valuable. That has changed. That's changed in the last year when we've gone from a market cap of 250 billion to a market cap of 1.7 trillion. And I think the thing is, with institutional investors getting into the market, they're going to demand more regulation akin to what you see in the securities and futures markets. They want to know that, in fact, these things are legitimate investments, and that, in fact, it's safe. And when you do the transaction, it's not going to be hacked. I mean, take a look at there's over 30 digital asset trading platforms that have been hacked. And Mt. Gox is obviously one of the most famous, but CoinCheck in Japan, which was hacked in 2019. You see, I've got 3 hacks there from 2019. $534 million in digital assets were hacked out of CoinCheck.
And so give us what does it mean? What does it mean when 500 million has been hacked? Is that stolen?
Stolen, exactly. And
so help us understand the issue of these, we hear about the passwords and the account numbers and the passwords and the effective anonymity of some of that. But then the question is someone invests and then the newspaper headline says that someone can't access their Bitcoin or their other crypto because they can't remember their password. And the question there is that basically a black hole for people that have lost their passwords, that they're not going to be able to recover the money?
It is. And in fact, actually, you read stories every couple of months about somebody saying, I have an account, but I lost my private key. I don't remember the password. And the account is worth millions of dollars now, and there's no way to access it. You'll see here on the crypto custody, this is a huge issue right now, and we'll talk our way through it here. Not your keys, not your coins. Point here is basically when you have an account and you're actually accessing that account on a digital asset, you normally have a private key and a public key. Public key is the address where it is held. The private key permits you to access it. Now, one of the things that we've been talking about is that most investors leave their coins in an exchange controlled wallet. So if you started, if you have a Coinbase account or a Gemini account or a Bittrex account, that account is actually at that particular trading platform. And it is something that they control both the public and private key on, even though they're holding things in custody for their customers. Now, the point that's made by a lot of people is that, listen, if you don't control the keys, then they're not your coins, because the exchange could go ahead and move those coins because they are the owner, at least based on the blockchain, of those assets. And that's exactly what happened with Quadriga CX, the Canadian exchange, where $165 million in customer assets, digital assets, were transferred by the exchange to accounts at other exchanges that were controlled by the founder of Quadriga CX, who then traded those monies and lost it. So it is a.
So I'm going to ask you a question, and just, whether I'm the only one in the audience, so to speak, that has this question, or it's just me, but where everybody does. So when I heard you say public key and private key, my first thought on private key was I'm used to the notion of a password, something that only I know and allows me access to what it is that I'm getting access to. When you mention having an exchange-controlled wallet, is that the same thing as is effectively giving your password to whoever controls the exchange?
Yeah, they do. And in fact, actually, that's the point, is that these people, when they set it up, it's kind of interesting. They'll tell you, okay, so look, we need you to, we're setting up an account for you. We want you to transfer in dollars and digital assets to the following address. And when you do that, it's going to show on the blockchain that you transferred your digital assets from your address and with your private key to another address, the address that is actually controlled by the exchange. And the exchange, there's no C for custody on that particular address, even though that is what the exchange is doing. And so once you have your assets there at the exchange, you can trade them. But in most instances, what's going to occur is basically, if you're buying and selling Bitcoin and Tether and things along that line, the exchange is usually going to internalize those transactions. That would be, they're going to match a buyer versus a seller on the exchange. And they will ask you, do you want to put this up on the public blockchain, or do you want it internalized? If it's internalized, we'll keep records of what occurred, but it's not going to show up on the public blockchain. It's cheaper. They say, we won't charge you a mining fee. Well, one of the things that Satoshi Nakamoto did was basically, he said, we want to solve the problem of double spending. We want to make sure that we're recording all the transactions that occur in Bitcoin, and we want to see all those. And the answer is, that's not happening today. The Bitcoin blockchain is not an adequate or current representation of who owns what in Bitcoin, because so much Bitcoin is actually held at digital asset trading platforms and wallets that they control, and the transactions have never been published to the public distributed ledger.
I have a question for you. Is there a consensus, and there may not be, but is there a consensus as to investor protection as it relates to having a public wallet or a private wallet?
I think the thing is that, they talk about wallets being hot and storage being cold. And hot wallets are linked to the internet and they are hackable. Cold storage is basically done offline or off the internet and is significantly more protected. So people would tell you that, in fact, first of all, you probably shouldn't leave your coins at the exchange. That would be one. Two, they would tell you if you're going to hold them yourself, do not put them in a hot wallet. Make sure you have cold storage that's not connected to the internet. You can do it on a thumb drive. You could do it on some hard drives on other things. You can even engage a custodian. And that's one thing I point out here is that there's the OCC, the National Bank regulator, has just said that national banks can be custodians for crypto, just like they're custodians for securities, commodities, and other things. New York State trust companies have been doing this for quite some time, and they could get a BIT license from the state of New York. Fidelity Investments, one of the big blue chip names in investment management in the securities world, started a digital asset custody business 2 years ago. And
would those all be examples of cold storage?
They have cold storage. They would be able to do that for you. In fact, actually, that's the right way to do it. But they will give you options. But to the extent that you're an active trader, sometimes you need access to your coins. But to the extent that you're a buy and hold person, and you want to basically make sure that you're protected, you should probably put them in cold storage.
I have a question for you that may be random or may just kind of fit into what you'd said about 10 minutes ago. But I have a question for you because we have these 8,000 plus tokens, so 8,000 versions or types or examples. Do any of them offer any of their the operators of those tokens? Do any of them offer a guarantee of any kind? Just thinking about the notion of the risks that people take. Is there any differentiation between those tokens that's emerging where there's some form of guarantee, or is that kind of a pipe dream of mine to think that's even possible?
Yeah, I think it's a separate issue. I think the point would be is that you have some of these exchanges and custodians who basically say we're insured, or we will cover any type of breach in our system, and so you have insurance. One thing that you should know is that digital assets, Bitcoin, Ether, and its ilk are not considered to be deposits, which would get FDIC or NCUA insurance.
So effectively, a regulatory form or a government-backed form of insurance is
right.
really not available.
The point would be is that the FDIC would tell you that, in fact, we insure deposit accounts where you have US dollars. We don't insure Bitcoin or Ether. So you're kind of stuck with the custody side of it, which is more along the lines of saying, well, we have insurance for our safekeeping, and the extent of the safekeeping insurance is what you got, and that's it. To the extent that you're talking about some of these might be securities, I would also note that, in fact, broker dealers, almost all of them are members of SIPC, the Securities Investor Protection Corporation, which is an analog to FDIC deposit accounts. And I've looked at this issue and written a paper on it. The definition of security under SIPC is very narrow. And I don't believe there are more than one or two of the 8,800 digital asset out there that would qualify as securities, such that if the broker dealer that held that digital asset for you failed, that you would probably not get SIPC insurance to replace that if, in fact, it had been taken or lost or something else.
So one comment that pops in my mind, just as an analogy, but we think about the value of insurance or effectively the value of an indemnity, a promise of protection against a loss of a certain type. But we recognize that those are only as good as the strength of the financial backing, so to speak, of whoever's making that promise, whether it's buying insurance from a life insurance company that's no longer there to pay out, or if it's a guarantee of any kind that someone gives on a loan where the guarantor has no assets or can't be found. So it sounds to me like that's an area where this is a bit of a moving target, but I was just wondering if there was a difference. I want to make sure we have less than 10 minutes left in our program, and I know you wanted to cover, at least get us introduced to stable coins. Do you want to take a few minutes there?
Yeah, I do. Just one last point on the insurance side of it. Some of the digital asset trading platforms in the United States have actually, they recognized, they went to the FDIC, and the FDIC said, we will not provide insurance for your digital asset accounts. Some of these digital asset trading platforms have gone off and gotten private insurance for the digital assets that they hold. So that it's kind of, there's no industry-wide insurance program like you have for FDIC for bank deposits or SIPC insurance for securities held by registered broker-dealers. It's just one thing that you'd have to look at and determine, because on some of those prior hacks that I showed you, the way that the exchange dealt with it was to basically say, well, we're going to cover what happened here, but we're going to assess some of the other deposit accounts to help pay for it. So they didn't even cover it by themselves. Kind of a bad thing. I mean, a really bad thing. But anyway, let's talk about stable coins and CBDC. So they're not the same thing. Stable coins, I think, you talked about it earlier, Mike. The volatility in the value of Bitcoin led to the creation of these things called stable coins, which were meant to basically keep a very stable value. Now, there's about 3 different types. Talked about that. You can have a stable coin that's based on gold, or based on the price of oil, based on the price of silver. You could also have them based on a fiat currency, like a dollar, a euro, yen, pound sterling. And then you could use a digital asset index. I don't think the only things that have been successful to date that I can identify in this space have been the fiat currency ones. Now, as I point out, there's a very small number. I'm only about 150 of the 8,800 tokens are stable coins. And most of these things are US dollar pegged. Now, the biggest point here is they're not legal tender. Even if they're backed by the US dollar or backed by the euro, they're not considered to be legal tender that someone has to accept. So it's kind of a, do you want to take it? Maybe you do, maybe you don't. It's a big deal because the Treasury Department and the Fed want to make sure that people understand that stable coins are not legal tender. They are not backed by the full faith and credit of the United States government. Tether is the most popular stable coin by far. As we saw earlier, their trading volume is almost $100 billion a day. It's off the charts. The Euro Tether and Sterling Tether have not been nearly as successful. There has been a big problem with stablecoins. You may remember the big Donnybrook with Facebook proposing Libra, which is now going to be called Diem. It hasn't launched, and this was more about the privacy issues related to it and concerns that politicians have about Facebook than it is about the product. But they still have Swiss regulatory issues. Now, on top of this, central banks and treasury departments are now worried about basically US dollar tether and other global stable coins. They're worried that they'll replace fiat currencies, and they want to have control over that. So it's a really big deal.
So tell us, CBDC, what do those letters stand for?
Central bank digital currency. And so many central banks are looking at CBDC. The Bahamas has actually issued a central bank digital currency. They call it the sand dollar. Cambodia has done this as well. You read articles every couple of months about China. They've got a pilot program on the digital yuan. And the BIS and G7 have provided or at least indicated that they're going to provide guidance on how CBDCs should look by the end of 2022. And the U.S. Fed.
Would you say that where do you see? I mean, I'm just asking you for your crystal ball. We recognize that this is a new area, but I'm just wondering from your study of the issue, does it seems like the attractiveness of a stable coin would be limited to the idea that it's a stable number. So in other words, what's worth $1 today is worth $1 tomorrow. But worth goes to the question of, is it really backed? Is it backed by anything? And you're explaining that stablecoin isn't backed by anything. It's just that it's been pegged as a value so that it's as a transactional number, it seems like it has some stability. But when you mention CBDC, now I'm thinking, well, now I've got maybe a government is issuing it. And so to the extent that a government is backing, normal currency that we're used to, I'm wondering do you see stablecoins suffering in comparison?
Mike, some stable coins are collateralized and backed by fiat currencies. This was actually a big deal with Tether, was that the New York State Attorney General did an investigation into US dollar Tether and just settled with Tether, fining them $18.5 million because they proved that US dollar Tether, even though they said that they remained fully collateralized all the time, that in fact, they were only 73% collateralized at a couple of different points in the last 2 years. So it's a big deal. The legal tender versus private issued. I think the thing is most people are going to stick with, a CBDC over a stablecoin. That would be my view. There's a bunch of issues that the Fed and others are trying to deal with in terms of privacy versus anonymity, whether it's going to be token-based or account-based, whether the blockchain they use is going to be permissioned or decentralized. There's a lot of issues going on there, but they are coming. Central bank digital currencies are coming. They will probably get rid of most of the reasons to have stable coins. There could be some surviving ones, but that's my view.
Makes sense. I appreciate you bringing those together in a dichotomy. We haven't talked about tax yet, and we are running out of this hour. I want to make two comments. One is I want to give you a chance to talk about taxation and at least touch it. And secondly, I want to just tell our audience that we may run over our 1 hour time slot just so we don't just cut off in the middle. But I'm not sure about how our Zoom platform is going to work. So we'll just keep moving forward. But be aware that if you've participated, you'll get an email explaining access to a YouTube video channel, which will allow you to watch or share this program. And if you were to provide any more questions in the chat box, even if we don't get a chance to answer them today, we'll try to answer them in that form. So Patrick, I alluded to income tax is what I'm thinking about, income taxation. What trends are emerging there, and how serious is the American or the United States Internal Revenue Service about taxation in this area?
The IRS is very serious about taxing people who hold digital assets. They were the second U.S. regulator to issue guidance in this area, just a year after FinCEN did. And they took what I think is a very reasonable point of view and said it's like property, treated like stocks and bonds. You have a basis when you purchase it, and then depending upon how long you hold the asset, it depends upon whether you get regular income basis or long-term capital gains treatment. They've issued some additional guidance related to hard forks and airdrops where people get additional coins or new coins. And they've actually litigated with Coinbase about customer records. And the court basically said, yeah, Coinbase has to turn this over. And the thing is that the IRS was saying very few people have filed tax returns indicating that they own digital assets. And versus the number of accounts that Coinbase is supposed to have and the amount of volume that's going on there, it seems like there's a huge disparity there. So they have upped their game and actually put the question on digital asset ownership on the front page of the Form 1040. So when you look at your tax form, this year, you should see, on the right below your name and address and social security number, you're going to see, did you own during the course of a year any digital assets? Did you buy, sell, whatever? It shows how important this is. And I think the government is thinking we're going to get a lot of revenue because look what happened to the market. So
Indeed.
you cannot avoid it, I think, is the bottom line. I don't know. Where do you want to go from here, Mike? Are we?
I think I might ask you a few questions, and if we have an opportunity, if anyone, it looks to me like I've covered most of the things in the chat box. But one thing that did come up was the issue of bribery, and the issue of that issue being addressed. Is that something you're familiar with?
One more time.
In other words, no, the issue of bribery through cryptocurrency, and is that an issue that you've seen come across the news or in the regulatory framework?
I haven't seen bribery, but I have seen, the people at FinCEN and the law enforcement people are very concerned about digital assets being used for drugs, for money laundering, for tax evasion, for, basically child pornography and things like that. I haven't seen it used for bribery, but there is a concern that a lot of people have talked about with respect to privacy coins. And law enforcement has basically said there's about 15 to 20 coins that provide more privacy than Bitcoin and others. And the law enforcement people have said, this is the antithesis of BSA and AML requirements. We need to know who's doing what so we can make sure that it's not illegal. So you're going to get, it could be the case that some of those privacy coins are used for things which people don't want law enforcement people to understand, and bribery could obviously be one of those.
So the word privacy coin, is that basically another way of saying trying to keep it secret that I own it?
Well, it's kind of interesting. Some of these privacy coins have the ability to turn on and turn off their what you can see about their transactions volumes. There's also these services called mixing and tumbling services, which attempt to obscure sort of the chain of title of particular digital assets as well. And there have been law enforcement actions against mixing and tumbling services, saying, this is, you're trying to cover up illegal activity. What are you doing? This is, not consistent with our requirements under BSA, AML, as well as FATF. So it could be that bribery is one of those things that, if you think that it will insulate you and make it so that people can't discover it, then that's what they'll try to do. I mean,
I have a question for you. That's just, we're going to jump around a little bit now. I have a question that came out of my looking at the chat box, and the issue is valuation. I guess what are the issues that are out there on valuation? We recognize that we see price changes when we think of Bitcoin and other tokens as investments. We look at ETFs, we look at value. But question is there an emerging consensus on how to value these assets?
I don't think there is. I mean, there's no consensus as far as I can tell. The reported value on some of the major, I guess, websites that track this stuff. You can go to Market Cap and CoinGecko and get basically current pricing. That doesn't mean that that's the price that you're going to get on a particular exchange for that particular, digital asset. Bitcoin, Ether may have a different price. There are reported differentials in Asia, I guess 2 to 3 years ago, they talked about there was a kimchi premium for basically buying Bitcoin on the South Korean exchanges versus buying them in the United States or Europe. And you'd have to pay up roughly 10% more to buy it on the South Korean exchanges than you would on the European or US exchanges. I also saw something the other day that said that the price of Ether could actually be very different from one US exchange to another, depending upon what type of liquidity you had for that particular exchange. It's not like the national market system for stocks, where in fact, everybody has to give the best price for investors who are buying things. It depends upon which exchange you're on and what the liquidity is for that particular coin. So I think the other part of that is basically like there's 8,800 tokens. And you got to think that the new ones that are coming in, just like in the equity space, do you have analysts who are looking at these things? Which analysts know what they're talking about? Which ones don't? How do you, sort of say, this is kind of like that coin that has this value and therefore we put this value on? I think you have a sort of arbitrary point of view being expressed by people in terms of the offerers saying, we think this is going to be worth, millions. So
what strikes me about this, and the notion of valuation or appraisal, when we think of physical assets or a business value or anything, you think about what is value, and in some sense, the word value is price. So in other words, if there's a willing buyer that's going to hand you a check or the money, currency, then you say that's the value. But on the other hand, we talk about supply and demand, and we talk about how is there, I don't know. I mean, maybe in my eyes it's worth X, and in your eyes it's worth 2X, and so really it's a very subjective concept, value, and maybe the most emphatic way to put that is that if I can get money in this second from you of a certain amount, then that's, even if it's based on price, that's the value. But if on the other hand, a year from now, are you really going to consider that the same value? So I think, one of the things that strikes me here is as we wrap up, we've got probably more questions than we've got answers, but you've definitely given us a lot of help, I believe, on vocabulary, on issue spotting, on where the action is and how much is changing. And I have a last question, which kind of goes to both individual countries as well as the world. We have treaties, amongst some or all countries, we have, whether it's in the U.S. with Congress and law, or whether in state law, or whether it be in other, EU and other systems, adopting legal structures. What are the trends, the immediate trends in 2021 towards international cooperation on a framework that would be a legal framework that would relate to some of the stuff we're talking about?
You might get an international cooperation on both stablecoins and CBDC in terms of legal tender and central bank issued digital currencies. I think that we're a long way away from having an international agreement about digital assets in general. It's kind of interesting. So we talked a little bit earlier about XRP and Ripple being sued by the SEC, saying it's an unregistered security. The UK FCA has said that XRP is not a security. Singapore has said XRP is not a security. And there have been other jurisdictions who have taken exactly the same point of view. So I think it's going to take a while for there to be an agreement about the non-stablecoin and non-CBDC arena. And I think that's, it's a funny thing. I mean, people say, gee, we need to have international agreement on these things. And I think the thing is that many commentators have said, each and every jurisdiction sort of comes to their own conclusions about how certain things should be treated. And that's the way it's happened for the last 80 years. Why should this be any different? So I think you're going to see that there's going to continue to be some questions about how you do it. The Europeans have their legislation, which is not all that detailed so far. And I think people are going to say, gee, the US ought to follow that. I'm just not quite sure that they will. And then you have some of the Asian jurisdictions, which are going to basically take a different point of view. I mean, you also have the problem with some jurisdictions wanting to basically recruit and be attractive to the digital asset world. And they're going to basically use lower, light touch regulation to basically attract them. And I think
strikes me the same way. You could go in the other direction of a stronger regulatory framework if you're concerned with attracting investors who are worried about whether it's hacking or fraud. But I think we'll leave it there. I want to thank you very much for putting your time together for this program, bringing your expertise. I know that you've been teaching this at the Georgetown Law School for a number of years, and because of that, you've seen probably every question I've asked and 100 more. And it strikes me you're in an area of emerging interest, a great strong interest both on the investment and on the kind of national attention side. Here we are in a global economy. We have an audience of people from around the world, but yet there seems to be an opportunity for divergent answers, which in the end, you look to have some way that we can, as a world economy, understand what we're dealing with and find ways where transactions which cross borders can be either facilitated or at least have access to tokens or cryptocurrency as a vehicle. And I'm going to leave it there because my mind is racing and my head is spinning, and I'm sure anyone listening to me would have the same problem. But thank you everybody for coming. Thank you, Patrick, for speaking to us today. Everybody be aware that we have a YouTube channel, and then within a couple of days, you'll get an email indicating a link to be able to watch it. And perhaps you'll make even more sense of it than I can right now. But thanks again, and we're going to be exiting the meeting, and I wish everybody a great day. And thanks again.
Thank you, Mike.
All right, bye-bye.